welcome everybody. This is our Fibonacci showcase, and what we're going to do today is uh, get a little foundation of what Fibonacci levels are and what Fibonacci retracements, what extensions they are. And I want to preface this before we jump into all the other information, is Fibonacci measurements themselves do not make a trade. Your trade plan needs to have a very specific place where you will enter the trade, have a protective stop loss, and then, of course, then having your potential profit in mind. Fibonacci measurements, along with indicators, oscillators, other forward-looking techniques like support and resistance or trend lines, and so on, you need to have a grouping of many different indicators, oscillators, and other techniques where everybody is thinking the same thing at the same price level. Now, what Fibonacci measurements do for myself, and I like to have that engineer approach, where I can verify and validate specific chart patterns. The Fibonacci measurements help me train my eyes to see those. Using the left-hand side of the chart, we look at chart patterns that have had a very successful price move in the direction that you intend. Okay. We'll explore a couple of these price patterns and kind of just touch the surface. Fibonacci measurements are not for every style of trading, especially for the artists out there. The artists kind of see the Fibonacci measurements and so on in a natural way. Us engineers, well, we got to have some basic measurements, okay? The measurements help us identify price patterns and the potential of the price pattern forming on the right side of the chart. As we get started here, the information contained in this presentation should not be construed as a recommendation or an offer to buy or sell any security or financial instrument. Additionally, information contained in this presentation does not imply the suitability of any investment strategy. We are not licensed brokers or investment advisors. All attendees of the presentation and purchasers of our content are encouraged to speak with a licensed representative regarding the appropriateness of investing, trading of any investment, and any trading strategy. We are using real-time market data and will execute trades in a simulated account during presentations. No offer on our part with respect to the sale or purchase of any security is intended or implied. Okay? And nothing contained in here should be construed as a recommendation to take a position in the market. The intent of this information is for instructional and educational purposes only. Any fair use of third-party trademarks, okay, or logos does not imply an affiliation or a sponsorship. All trading involves high risk. Past performance is not indicative of future results. We make no promises, guarantees, warranties suggesting that any information shared will result in a profit and not in a loss. And you agree to not hold us legally or financially responsible for any reason. Okay. So let's jump right in. Let's get some basics of Fibonacci measurements. Now, as I prefaced before, Fibonacci measurements alone do not make every trade. There's information on the chart, information outside the chart. There's a lot of time when that symmetry aligns. Many traders that use Fibonacci measurements are normally and quite often drawing their lines from the wrong place, okay? And you get varied results. Even many of my peers over the years, very well-known and sophisticated traders, okay, often shy away from Fibonacci measurements. They say they're too inconsistent. They're not seen, they seem a little more random, okay? The main reason for that is they're drawing them from the wrong place, okay? The other reason is that when they start studying a picture-perfect past trade and you start looking for all the measurements that align, okay, they're often looking for the wrong picture, okay? So we're going to look at a couple of little basics. The Fibonacci measurements that we see, we notice them a lot in nature, kind of a hidden order to nature's design. One of the amazing parts of the mathematics is the discovery of the numbers list that mirrors patterns found in nature. These instances create a sense of belonging to the universe, a sense of some kind of grand cosmic interconnections, okay? And practically like magic, rooted firmly in science and in mathematics. The Fibonacci sequence is one such example, but what is it? How do we use it? How is it defined? How is it created? What are some examples in nature? Okay. There are a couple of websites, thegoldennumber.net, a great resource to go out and look at to get a lot of good examples of things that are Fibonacci related, whether they're plants, flowers, universe, weather patterns, an artwork, okay, how it proportionately set up to make it look attractive to you. And we also see them in the price charts. So some basics here. We're always using a prior swing down or a prior swing up. The retracement level is the bounce back up, retracing the prior swing. The more common Fibonacci retracements and extension levels, okay, would be the 23.6, 38.2, 50, the 618, 78.6, and 88.6. Now, if you're drawing from low to high or high to low, okay, depending on the software that you have, the retracement back up inside the prior swing is what we are measuring to look for. The prior swing is 0 to 100. The move back up or the move back down related to the prior swing. Using those percentage retracements, we often see that price changes direction off of those levels. An example here. Here we have a nice down move, the prior swing, and then price bounced up. That would be a retracement. By measuring from the high point to the low point, price retraced, and then you would be able to answer that question, whether it's a 38, 50, or 618% retracement, which are more common retracements in the industry, okay? A lot of folks use this. They don't use it as a precise turning point, okay? They use it as a percentage retracement, okay? And another example, price moving up and then retracing back down, always relating to the prior swing. The pullback or buying on the dips is considered a retracement, okay? Price pulled back or retraced, okay, relative to the prior swing. More common Fibonacci levels are the 38.2, the 50, and the 6.8, and these are labeled as retracements, okay? Now, I'm alluding to information over to the left-hand side of the chart here. Very often when measuring Fibonacci retracements and extensions, you need a good solid starting point, okay? Most traders just go from peak to valley and valley to peak, okay? What I would encourage you to do is look for where you have a resistance level, where prices hit multiple times, more than three or more, excuse me. And then the area below becomes your buy territory. The pullback or retracement levels are generally within that buy territory that provide a desired trade outcome. Okay. Fibonacci price extensions. A Fibonacci price extension is using the prior swing, and then when price extends beyond that prior swing, we have more common Fibonacci extensions, a 113, 127, 1618, 224, 2618, and 314. Okay. When price extends beyond the prior swing, we use Fibonacci extensions. On a special note, where I learned a lot of Fibonacci measurements, price patterns, Fibonacci extensions, retracements, and the use of Fibonacci retracements and extensions as a forward-looking technique, my resource comes from, or many of my resources come from things that I've learned on the outside of and on the internet. But one main source, Scott Carney at harmonictrader.com, has been very influential in showing me the precision of how Fibonacci numbers work. Okay, so some of my resources, some of the information, I want to give Scott credit, always giving Scott credit for, and appreciative of what he has shared with us in the open market. That's harmonictrader.com. So here we have price moving down and then shooting up as we see that. Now we have a Fibonacci price extension. Okay, price extended beyond the prior swing. With Fibonacci extensions, we can anticipate various different types of chart patterns going to the right side of the chart. A 113 extension is often an irregular topping pattern where price kind of breaks out a little bit and then has a very strong momentum reversal. A 127 or 1618 extension are very much associated with head and shoulders tops, head and shoulders bottoms. As you get out to the 224, 2618, and 314 extensions, these are often aligned with a V top or a V bottom price pattern. Okay. So not only do the Fibonacci measurements come into play, showing us what the measurement was based on the prior swing, is they start to allude to us potential price patterns to make a trade opportunity. By understanding what extension or retracement price comes to, then we can forecast the right side of the chart and anticipate where we might have another profit potential. Okay. Fibonacci confluences also are a very big part of understanding where multiple time frame analysis, multiple traders from pulling Fibonacci levels from different levels would align together, kind of overlap. A Fibonacci confluence is where we get a collection of Fibonacci retracements or extensions on various price swings, meaning, excuse me, we have several different ways or different folks looking at the same chart. Okay, they might be looking at it on a higher time frame or a smaller time frame. But when we take those measurements and we start seeing that from a higher time frame, Fibonacci levels align with retracement extensions, and then on smaller time frames, they kind of overlap. We have multiple Fibonacci traders and different time frames thinking the same thing at that same price level. At that same price level, you have a confluence. It can be at a support. It could be at a resistance. It could be at testing a trend line. It could also mean that price pulling back and starting to make a turn back up is that your indicators and oscillators start to align with these areas as well. The more traders thinking the same thing at the same price level, things become a self-fulfilling prophecy. The theory of confluence, is that multiple Fibonacci and extension retracement levels are at and near one price level. Price will likely be an important potential turning point. A trader can then use that potentiality to make a trade and manage risks near that level. For example, I tend to use 3 swings. Now, if I'm looking for a projected move, price move, I'll use a swing up, a swing down, and then a swing up. So 3 price swings and measuring from low to high on each one of these, extending beyond, looking for 113, 127, 1618, 224, 2618, or 314, and seeing where they overlap. Okay. Now here we had price swing up to the upside, and then we saw multiple Fibonacci price extensions lining in the same area. We would anticipate that there may be some unfilled orders there and price to bounce off of this level. Conversely, down below, we have a couple of lower areas where we have multiple Fibonacci price extensions also in the same general area. So not all Fibonacci levels are going to be a reversal and change trend. Sometimes they just show you an area where we're going to see a little more consolidation. Okay. There'll be some unfilled orders and some expectations. Okay. So not every Fibonacci price extension or retracement is a place that's going to start a new trend. Okay. They can be areas where we could use for price targets, where we might see multiple participants see at the same level. With each price swing projected, the Fibonacci price extensions draw a box around the area where multiple lines converge and price potential price targets. Now, we've just recently done this on gold. Okay, I went out to the larger time frame on gold, and by using 3 swings in price, and I used this the other day, going from high to low, using 3 swings and using a 50 simple moving average as a mean. I'll just plot these on here. So I went from high to low because I want to extend my Fibonacci extensions to the upside. When markets are making all-time new highs, Fibonacci price extensions using 3 different swings here become very, very high probability turning points. Profit potential, not necessarily making a trade. Okay. So plotting my Fibonacci from high to low on this small swing and on this larger swing, and now one more to get that Fibonacci confluence. We can see that we had multiple Fibonacci lines lining up around this 3007 to 3000 level. The next confluence level we have will be up around 3077. Okay. Now, again, you don't want to start taking short trades off of all-time highs. Okay. You want to use the confluence levels as a place to potentially take a profit. Okay. Now, once you've identified the area, just simply remove all the noise off your chart so it doesn't look all cluttered. Okay. Let me get that horizontal line. We have a new all-time high. I find this to be very, very helpful when stocks are going to all-time highs, using as a place for a projected move. Okay. All right. So let me give you a little more content, and then we're going to jump out and look at some of the charts. So we've covered Fibonacci retracements, Fibonacci extensions. We have a set of numbers for the extensions where we are looking for the 113. All the numbers are right here: 113, 127, 161.8, 224, 261.8, and 314. Okay. Retracements would go from 23.6 38.2, 50, and 61.8, 78.6, and the 88.6. Okay. So let's blend this a little bit together. Here we got Fibonacci measurements and the TMI method, the market institution. When we're looking at areas, and think of the Fibonacci tool as a measuring tape. Now, many of you have used a measuring tape in your life, and it has that little hook on the end. Okay, you hook that in, and then you pull the tape, and then you get a measurement. Okay, so where do we hook that measuring tape? Well, we use the leg base group of candles. This becomes a very consistent way of seeing where we can hook that measuring tape to get an accurate measurement. Okay. When we are looking for that place to have that accurate measurement, you may need to adjust the time frame down. Here we have the 2 candle flip. We have wick over wick areas, a drop base drop or rally base rally. But if you look inside of each one of those variations, you'll find that they have the leg base group of candles. Okay. So this is a place where price changes direction many, many times. By hooking our measuring tape at that level, the distal line on the leg in, the base, and leg out, or the rally, the base, the drop, or drop, the base, the rally, okay, our Fibonacci measurements become a lot more accurate. All right, so a couple of examples. Like I said before, we combine the Fibonacci measurements with a leg base located in a sell territory or located in a buy territory. Okay. So location is very important. Okay. Using the leg base group of candles from high to low, you might see that, hey, there's an 88.6% retracement, very consistent to get the 88.6. Okay. But if you're going from peak to valley, okay, you might get that 618 or 78.6. Okay. Now, both of them are valid, and where they overlap, you get a confluence, kind of a meeting of the minds where traders are thinking the same thing at the same price level. Okay. Using the left side of the chart, a trader can train the eyes to see repeatable price patterns when they occur. So for example, resistance, and we have our buy territory, and then we see the price pulled back into that area. And if you're going from the distal line to the rally, you see it came right back to that 88.6. Okay. Using Fibonacci measurements, a trader must also be able to understand multiple time frame analysis. Every piece of information is just that, a piece of information, not a trade. When we have many pieces of information overlapping in one specific area, then we look at that area, find the leg base, understand if it is in the right place, and then we look for that desired trade outcome, whereas we can manage our risk. Okay. The things you will learn in our, and I'm going to take you a little deeper dive into what we teach in our Fibonacci course, a little slower, a lot more detail, and more specific ways to measure these price patterns. We use the Fibonacci measurements to forecast potential turning points, the next potential move. Okay. Fibonacci measurements is not an indicator or an oscillator. It is labeled as a forward-looking technique, very similar to support and resistance and trending or trends, uptrend or downtrend. Forward-looking, you're anticipating where price may turn in the future. Fibonacci measurements help with a confluence level, And of course, identifying the leg base group of candles in the same forecasted area increases the probability of a successful outcome. When forecasting the next possible price move using structures is first to have an idea of structures that are consistent, that you can measure and document, okay? And they often reoccur. Retracements and extensions both come into play to visualize 2 to 3 price swings to prepare yourself mentally for potential risk and a confluence level that will have a bigger impact on how you plan to act. Having a forward-looking technique helps you anticipate a place in time and in price where you're willing to engage in the market. You're also wanting to expose the risk ahead of time, and you want to be right. You need to learn the left-hand side of the chart first to change your belief system, to be able to anticipate the right-hand side of the chart with a high degree of accuracy. This means taking the time to study picture-perfect past trade setups. We're going to look at a few of them, okay? Since we're always looking left for the leg base, for additional confirmation, unfilled orders, and the structures often or offer where price potentially will change direction. The structures are like maps. Remember, we don't drive on the map. We use it as a guide. Reminds me of Dr. Woody. Okay. Also important to plot the higher time frame structures to see what is ahead of the next price movement and how small structures tend to build into the bigger structures and, of course, back the opposite direction. Markets are always moving back and forth, okay? So by measuring a larger time frame and getting the general trend direction, okay, you can use smaller time frames to splice in using Fibonacci measurements, splicing into that larger expectation, or the expectation of the larger time frame trend. Remember, the structures and Fibonacci measurements, when you're visualizing the right side of the chart, they act as a map, okay? Using the leg base, we're able to expose an entry and a stop loss area where we can protect and know the risk ahead of time. Some basic structures that are part of my universe of structures that I look for. The ABC structure is a trending structure, and the ABC structure comes after the reversal. You can see where the ABC comes into play, but the information in front of that, okay, can also help us anticipate if we're looking for a head and shoulders, a double top, a double bottom, okay? And once we get the reversal patterns, then we look for the trending. They happen in a sequential arrangement, okay? V-shaped reversals are often very aggressive, price change, direction change, okay? And I like finding the V-shaped reversals or a momentum reversal, okay? And we need to know where those Fibonacci measurements using the prior swing, like in this example from X to Y, A equals a 113 extension. Well, once you start aligning your extensions and retracements, then you're able to visualize the next 2 to 3 swings to the right side of the chart should price follow the structure and pattern, okay? The visualization process helps us understand where our potential trades are based off of using some swings that are already intact, okay? Elliott wave, again, a map on the price chart, can offer a lot of information as to where price is relative to the map. We always start off with reversal patterns. The next one is a trending pattern. That's where your ABC comes into play. Then we have continuation patterns, and then reversal, trending, continuation, and reversal. And as we map those out with Elliott wave patterns, often the first wave up is wave 1, the pullback wave 2. This is often a simple correction and probably one of the easiest ones to spot. Not to trade yet, but to spot. Then we identify continuation patterns. Now, continuation patterns happen 2/3 of the way through this cycle. It's like a movie. You have the opening plot, and then things quiet down. Then you have the other story thickens, and the hero and the villain start fighting it out. Hero comes back to save the day. Okay. We see this particular price pattern and the movements, as price moves up and pulls back and breathe in, breathe out. It's a natural form of how we see stories, we see music, we see plays. All sorts of many things are tied to this particular pattern. A song, 2/3 of the way through the song is where the crescendo comes in, okay, and so on. So when we're looking at using Fibonacci price extensions and retracements, reversal patterns often align with the 78.6 or 88.6% retracement of the prior swing. Whereas trending patterns, 38, 50, or the 618% retracements come into play. Forecasting out is where we would anticipate the price end of the price move, okay, and using them as a projection to look for a profit target. Some basic rules around the Elliott wave map. Wave 2 does not violate the low of wave 1. Wave 4 does not go into the price territory of wave 1. And wave 3 is never the shortest wave. It's not the longest. It's never the shortest. Okay. So these are rules right from Elliott himself. Most of the new folks around Elliott wave have never read Elliott's basically his work, and they're using much newer stuff. I encourage you to go back and read and research. Now, Elliott, most of his publications came out in the early 1930s. These maps are still very close and very similar. These do not provide a lot of trading opportunities, but they tell you where you're located, whether you're high on the curve and to anticipate a reversal, or whether you're low on the curve at the end of a downtrend and beginning to look for the move back up. Okay. When we're looking at our price patterns, Fibonacci retracements, okay, of a 23.6, a small retracement is often associated with a momentum move. It's going to continue in the direction of the prior swing. A 38.2% retracement, the 50%, and the 618 often coincide with a ABC pattern. When we're looking for double bottoms or double tops, 786, 88.6 retracements tend to be what we're anticipating. Now, I just mentioned Fibonacci retracement levels, okay? And then we associated each retracement level with the potential outcome. See the ABC pattern, price pulls back to the 38, the 50, or 618, then we're looking for price to continue. Basically, the AB leg looking like the CD leg, okay? With a momentum retracement, we often get a shallow retracement. Price does not pull back too far, but then resumes trend, okay? When looking for reversal patterns, often the deeper the retracement, okay, the more we're looking at a reversal, okay? Fibonacci price extensions. Momentum reversals come off at a 113, okay? We often associate that with a little speed bump area and price breaking support. Now, momentum reversals often have some other clues in the structure within the sell territory or within the buy territory that can help us determine whether that is going to be a momentum reversal. 127 and 1618 Fibonacci extension aligns with head and shoulders pattern. Yeah, head and shoulders patterns have a lot of variation in shape, but if you measure the right shoulder and get the extension to the top of the head or the bottom of the head, okay, you often see that the top of the head matches up to a 127 or 1618. Therefore, if you know it's a head and shoulders pattern, potentially, then you could anticipate the price movement back up, another shoulder to form, the left shoulder, and then a break of the neckline, okay? Versus a V-shaped reversal, often price has a very steep drop or rally as price goes into the 224, 2618, or 314 extension. It is rare to get a 314 extension. More common, the 224, 2618, okay? But each one of these now, using Fibonacci price retracements and extensions, okay, have created a picture, whereas you can visualize the right side of the chart. Let's go out and look at a couple of charts. Now, I'm going to look at charts where I have a desired trade outcome, okay? So I can notice that at this point, there's a nice entry. This would have been a great trade to get long in. As I look over to the left, okay, I want to first identify where we have that leg base group of candles. Now, the leg base group of candles that I just outlined right there, okay, is where I'm going to hook that measuring tape. And don't forget first the step one. This is a place I desire to take a trade long. In trading, we have to focus on what we want to create, what we want to manifest in a trade. This is a successful trade. Looking over to the left, I have identified the leg base group of candles. Identifying using the distal line of that going up to the rally, we start to form a shape. Okay, I can see that I have dropped the base to rally, and price came back down and retested that area. Now I want to see what the measurement was. Okay. Now, once we start identifying what that Fibonacci measurement is, okay, and we can see that it came right back down to the 88.6% retracement. Okay. Now, that's often associated with more of a reversal pattern. So to make sure that that leg base is in the proper location, we would furthermore dive into the information over to the left-hand side of the chart, find our resistance area, and make sure that the leg base is in the right area of buy territory. Gaps often represent the strongest order imbalance, okay? So the fact that price gapped right through all of these sellers tells us that there are leftover unfilled orders here. The precision of the measurement is quite impressive. Now, what we've identified is a pattern, a structure, okay? To apply this as a trade, you would identify the leg base group of candles. You would then look for your entry in looking at the leg candle leaving the zone, compare it to the candle in the zone. Excuse me. And get an idea if the zone can be used once or
Order
twice,
filled.
right? All right, looks like we just got in the S&P. Okay, price coming back out of that area. Still looking for that gap fill. And we're still in our NQ trade, still looking for the gap fill all the way back down to this level here. Okay. All right. That was from our live trading room earlier. All right. So as we go through stock after stock, and it doesn't matter the time frame, okay, what we're looking for is an understanding why price stopped and changed direction. Any place on the price chart, just identify where you would have loved to taken a long trade. And look at that nice move up. Then look over to the left, isolate your leg base group of candles. Okay. Now I want to see from the prior swing using the distal line to the rally, how far did price pull back? Okay. Now, very often the 88.6% retracement, which is a square root of the 0.618314, 034, that Fibonacci retracement, the 88.6% retracement, is a very strong place where we often see price bounce. Okay. Now, the area of the Fibonacci retracement, okay, is important. The leg base that makes the zone is how we understand the risk involved in taking the trade. As we look at this trade here, going from point A to point B and then a retracement back C, we have places where we can anticipate profit targets. Okay. Now, we utilize the left-hand side of the chart and we find these retracements and extensions that tend to show up over and over and over again. Okay. So using this as a forward-looking technique, we can see that price dropped right here. Why did price stop here relative to the prior swing? Okay. So going from low to high, okay. We also look for that where we'd have that leg base group of candles. Okay. I might have to go up a time frame here. Okay. But as we're looking for a retracement back down, price dropping. Now we've already shown you a couple of price patterns. We have the drop to base to rally, rally to the retest, where we make a slight higher low. We've already established that the 88.6% retracement, okay, that higher low than the prior low is a great place to look for a trade opportunity. Why do we understand that? Well, we're going to look at hundreds of past picture perfect trade setups. We notice that higher swing low, okay, and we look for the characteristics of that. Now we just have to anticipate where that turning point was. The leg base group of candles helps us identify what the risk on the trade would be by having a place to enter the trade and place your protective stop loss. The measurement from the distal to the rally, we would like to see line up with 88.6% retracement. This will help us identify and visualize what we could expect to the right side of the chart. Okay. See, the Fibonacci measurements come into play, but using the leg-base group of candles is what we're going to identify to help identify the risk, our entry point, and our stop loss. Okay. Let's do one more. And this can be done on any time frame. Okay. Here's an example. Notice how price poked up a little bit. Okay, going from high to low, we have that swing down, and then price pops up just a little bit higher than the prior swing, outside the prior swing. This would be what we would start looking for is a Fibonacci price extension. And we would turn on the 113, 127, 1618, 224, okay, and so on, okay? So price popped up, hit the 113 extension, which then gives us the next move down, shallow retrace, and then a continued move down. Now, with that first measurement lining up, we're able to associate a price pattern that typically uses that, okay? Coming back down to the bottom of this move down here, we can see that this is the origin of a strong move up, and we would just take and kind of trace out. We have that drop to base, base to rally, rally to the retest. We're making a slight higher low, and you would start to get those measurements. Now, once you confirm the measurements are there, then you're already training your eyes and your brain what to see on that price chart, right? How to visualize the right side of the chart. Now, Fibonacci measurements are just that. They're there to help us identify what potential price pattern we could look for. CRM on a daily chart, as a trade example. Notice that we have a price swing up and now price swing to the downside, okay? It's a nice steep slope. So I want to know, is this potentially a V pattern? Because that would give us a nice strong momentum move back up. Measuring from low to high, then I would turn on the Fibonacci extensions. And with those extensions, 314, 261.8, 224, 1618, 127, 113, okay? We would then get the idea that, hey, price has not, it went beyond the 1618, okay? So it is not the price pattern I'm looking for at the moment. For a V-shaped reversal, it would have to come down to one of these levels, okay? But I'm noticing right here at the bottom, I'm noticing this price pattern right here. Did we make a slight lower low? Well, let's adjust the time frame and find out, okay? So I'm going to drop down. Oh, excuse me, scared me. Drop down to let's try with 20-minute chart. Now, in a 20-minute chart, we can now visualize that we're not looking at a double bottom anymore. As we can see, the price broke and went slightly lower, okay? By measuring the prior swing, we're now looking at extensions outside of that range. And for a momentum reversal, we would be looking for price to hit a 113 extension. What we verified is it didn't hit the 113 either. No trade, okay? It's not the picture we're looking for. If price hit the 113 extension, then we would have the measurement to visualize the next couple of swings to the right side of the chart. Fibonacci measurements, extensions, and retracements are always used in confluence with other price patterns, okay? Let's take a quick look at the marketplace now. We're starting to see price moving lower. Right, so I don't have anything really set up, but you could see this morning's action. See where price, where we had this drop to base to rally, and then price made a slight higher low. Take the time and measure that. The more times that you measure these, you will start to see that 88.6% retracement comes into play. Okay. Now, when that 88.6% retracement comes into play, locate your leg base, and the potential for a trade opportunity may come into play. Okay. Again, start off with any place you desire to have made a trade. Okay. Any place you have desired to make a trade, and then start measuring. The more that you measure the price patterns and the structures, the more comfortable you will be to come back and trade them. Okay.